Gold and silver prices seem to be in the upside down. For those who haven't seen the Netflix show Stranger Things, first, what are you doing with your life? But more importantly, the upside down is an alternate dimension that mirrors our world, but not quite. It's this toxic hellscape of a world overrun with creepy, moving vines, murderous predator creatures. It's a place where the rules of physics don't really apply the same way as they do here, and light, sound, temperature, gravity, and a few other things look familiar, but aren't quite really the same. And everything's covered in this web and like gooey like substance, which seems to cover every part of this world. There's darkness that permeates everything. And let me remind you of those murderous predatory creatures. All of that makes for an unpleasant version of the world we know, and one that would be horrifying to be stuck in. I could be crazy, but that almost sounds like the flowery description of the crooked financial system we're all trying to navigate. I mean, Jerome Powell would be Vecna, and the murderous predator creatures are the banks and hedge funds and policymakers trying to destroy us and our way of life, like the Demogorgons. The lies they tell and the manipulations cover everything like the web and gooey substance in the upside down. August was an interesting month, which really made me feel like we were in the upside down as we saw the DXY go from 102 to 104. We saw bond yields rise, and somehow gold and silver prices not only held their ground, they actually increased. But more importantly, we saw silver flex some serious muscle and have bigger gains than gold as the GSR started the month off at 82, crept up to 84, only to drop as low as 78 and ultimately settle at 80. All of this was despite the strong headwinds from both real interest rate expectations and realized real interest rates. Meanwhile, economic data continues to paint a neutral to slightly positive economic outlook, but that view, I think, largely depends on your frame of reference. We saw consumer confidence slide 10 points, PCE and core PCE come in around expected levels. Jobs came in slightly higher, which was counterbalanced by unemployment coming in higher by 0.3 and ultimately at 3.8%. The BRICS held their summit and didn't announce or even discuss a gold-backed currency, while Powell and his Fed homeboys and homegirls continued their hawkish talk from Jackson Hole. This is why I felt like it was a little like the upside down, as through it all, somehow gold and silver prices gained, as I fully expected prices to retreat. We will have to see how my earlier prediction ultimately holds up. During our recent Discord session, I guess I need to say this again, but what are you doing if you're not on Discord with us? But at any rate, during our session, we briefly discussed bond yields and in particular the use of short-term treasury bonds to do what is referred to as cycling as a way to earn some decent returns on cash or holding as reserves or on the side. I mean, you can get 5.5% on a 1-month T-bill, which is insane, versus 4.29% on a 30-year. Which leads us to today's topic of the inverted yield curve and its direct impact on gold and silver prices. The inverted yield curve is really important as markets continue to struggle with one of two likely realities. One, the Fed, despite the recent banking crises and other red flags in the monetary system, remains undeterred in getting inflation under control in the short run. The banking crises have been contained, inflation's under control. Any economic downturn will be mild and short-lived, which means the Fed will adopt a more accommodative monetary policy via lower rates, but not necessarily QE. Or the second option, the Fed's action will cause or is in the process of causing a massive recession and potentially a larger scale banking crisis, which then will force the Fed to do a U-turn, slash rates to zero, and restart QE. In this scenario, inflation may come down further as the recession unfolds, which could lead to commodity prices crashing, the labor market shifting from very tight to very weak, and asset prices collapsing. The problem with this scenario is that the standard monetary Fed actions they would take to counter this would actually lead to higher inflation down the road and higher gold and silver prices. This is why the inverted yield curve has become such a hotly discussed topic recently. But what does this inverted yield curve really mean for the average person? An inversion occurs when short-term interest rates are higher than long-term interest rates. This is a bizarre scenario because most of us would agree that if I were to lend you money, the longer period you have to repay me would require a higher level of interest for a variety of reasons. Real quickly, let's review yield curves. A normal yield curve looks like this, where the shorter maturity time period corresponds to a lower rate of return, while longer term means higher rates. In addition to a normal yield curve and an inverted yield curve, we can also have a flat yield curve, which looks like this. But what we need to discuss is this chart, an inverted yield curve, as this anomaly has successfully predicted and preceded every economic downturn over the last 50 years. Now, before someone asks me in the comments, economists do not consider brief inversions in that statistic. It's also important to note that over the last 50 years, it has taken as long as 18 to 24 months for the recession to show up. For example, in January of 2006, The curve inverted, but the market rallied for another 2 years before we finally experienced the pain of the GFC in 2008. Another example was during the late 1970s and early 1980s, where we experienced multiple inverted yield curve episodes. During this time, gold and silver prices rose significantly due to concerns about inflation, a weakening US dollar, and geopolitical risks. Wow, that sounds awfully similar to today. Most people think about it and often overreact when the yield curve inverts, for good reason though. But we have to remember that it's when the yield curve uninverts is when everything changes. Beyond understanding its predictive power, we also need to understand what drives the shape of the curve, as you hear people talk about the short end and the long end of the curve. Basically, the Fed's fund rate is what drives the short end of the curve, which is 3 years or less, while 20 and 30-year rates or the long end of the curve are really connected to GDP, as it tracks that number very well. The long end is really about the future economy, growth, and inflation expectations. If you can remember what drives the short and the long end of the curve, then you can see the Fed recently raising rates so quickly would lead to an inversion, as well as why the Fed cuts rates as a way to stimulate economic activity. But ultimately, an inverted curve is the bond market and investors telling us that they see more risk in the short term as compared to the long term. As a result, investors and lenders require higher rates in the short term because of the perceived risks and pessimism in the near future. It is this perceived risk that is typically great for gold and silver prices, as people seek safe haven assets during times of uncertainty. But you've guessed it, this requires us to be patient as policymakers keep finding ways to keep the curve from uninverting and bringing on the recession. Understanding that most of the time we are told about a recession after the recession has actually started, the typical central bank response is to lower short-term interest rates as a way to stimulate economic activity. This highlights the problem with the ZIRP, zero interest rate policies, because when the yield curve is inverted, the central bank's ability to use monetary policy to stimulate the economy is limited because they can only lower short-term rates so far before they actually reach zero. This situation is known as the zero lower bound, and it can lead to a situation where the policies just aren't effective in stimulating the economy. In my opinion, this is part of why Powell raised rates so quickly and so high, because he needed room to cut in the future. I mean, what's the point of having a gun during a shootout if you don't have any bullets? If the Fed had only raised rates a few points, this potential zero-bound issue would have become a much more serious problem. I'm gonna get some hate for this, but I have to admit, it was kind of genius of him and the Fed. I mean, after screwing up things in the first place. But Powell knew he needed rates higher to fight inflation, slow down an economy. So when they actually got into trouble, they actually had the option of cutting rates. Again, here's the problem. Cutting rates would have a stimulatory impact on the economy and would lead to greater inflation, which is what they are trying to battle. This is why he keeps preaching higher rates for longer. He has to make everyone believe that the stimulus is not coming because of what it will do to the markets, especially real estate, which is highly inflationary. Here's the thing you have to remember about real estate. It's not just the impact of higher prices being inflationary, it's all the associated spending that comes with real estate purchases and sales that is incredibly inflationary. You all know, I know this firsthand, as I documented my personal story of the ancillary costs associated with the purchase of a new home for our family. I knew I was going to spend some money, but I had no intention of spending that kind of money. Powell knows that cutting rates will cause the real estate market to take off, and simply because of supply and demand, prices will continue to go higher. And that demand would cause a bleed over in spending in other areas of the economy, and inflation would come roaring back. So all of this leaves us gold and silver investors like a sailboat floating in the ocean, waiting for the wind to start blowing so that we can continue to sail to the happy land of metals and commodities. Carrying this analogy a little bit further, the challenge is that we left the shore in our boats early, essentially giving us a head start, while the other boaters are still waiting on the sidelines for confirmation of strong winds. But once they receive their confirmation, we'll already be halfway to the happy land of metals and commodities. But being early, floating at sea, patiently waiting for the big winds can be very frustrating. It can also make you question whether or not this was a good idea to start early. Do not do that to yourselves. I'll give you one last analogy. It's like if you went to a nightclub at 10 o'clock to get in for free and to take advantage of half-off drinks. 10 p.m. is not the time to judge whether or not the club is going to be popping. It's way too early to make that determination. Instead, we need to chill, relax, enjoy ourselves, knowing that eventually the club is going to be packed, as the masses, all at the same time, will rush to the club and end up wasting half of their night standing in line trying to get in. Eventually, the yield curve has to uninvert. So don't question if gold and silver are a great investment. I want you to think about this as a preparation time for you to get your gold and silver positions the way you want them, because the yield curve Uninverting is not an issue of or a question of if, but really when. The recession is not a question of if, but when. The Fed cutting rates is not a question of if, but when. People running to the safety of gold and silver is not a question of if, but when. In the comments section, did my explanation on an inverted yield curve make sense and help you? Are there any other topics you'd like for me to explain? Or you can simply hit the capital A and then the plus sign to let everyone know that you always stack smarter and never stop learning.